Hello, I'm Linda, and this is No Frills ASMR. And today we have special guest Greg here.
Hello.
This morning we were having coffee hour. Well, some of us have coffee.
Tea.
And Greg brought up, well, one of our sons is thinking about buying a house sometime soon. And so Greg brought up the 50-year mortgage. And the reason why that came up is generally mortgages are 15-year or 30-year. But recently, Trump has floated a 50-year mortgage. He was talking about it. And then I think like yesterday or something, he truthed a thing that said great American presidents. And FDR is the president who started the 30-year mortgage. So he posted FDR and then himself with the 50-year mortgage.
I should clarify and say that when I brought up the 50-year mortgage, I didn't bring it up like in a good way.
Well, we were discussing whether it's good for some people or not.
So who started the 30-year mortgage?
FDR.
Right. And I was reading about that. That was back in like the 1930s, late 30s. Well, what was interesting was, the loans before the 30-year mortgage became standard, like back during the 1800s up until the early 1930s, the way mortgages worked is you'd borrow money from a bank, and the loan periods were very short, like 3 to 5 years. And all you'd pay is interest only. Then at the end of the mortgage, you'd have a big, huge balloon payment. And you'd pay off the balance.
Mm-hmm.
Well, most people couldn't afford to pay off the balance. They didn't have the cash, so they just refinance. So typically you kept refinancing for another 3 to 5 years, and it was interest only. Well, this was fine for a while until the Great Depression, when all of a sudden the banks failed, refinancing dried up, so people couldn't refinance. People didn't have the cash to pay their balloon payment at the end of the mortgage.
Mm-hmm.
They were unable to get new loans. And so there was this mass foreclosure across the U.S. Just everybody, just all across the whole nation, there was all this mass foreclosure, and people they lost their homes.
Mm-hmm.
So that's where the government stepped in and said, how are we going to fix this problem? And they came up with this 30-year mortgage. And they came up with 30 years because 30 years was a good number as far as like monthly payments go. And
Well, and I think at that time it was assuming you're married and buying a house in your early 20s.
right.
So by the time you pay it off, you're in your early 50s. You're ready to retire because the retirement age used to be in the 50s, right? I think. So,
yeah,
it kind of made sense for people.
retirement age is, it's slowly crept
Creeping
up.
up.
Yeah, as we get older, yes.
As we get older, as we get closer to it, it keeps creeping up.
Right.
Not that we get any retirement.
So the 30-year mortgage has been standard, since the
Well, I'll tell you,
40s, 50s, and 60s.
Roosevelt was president from 33 to 45.
Okay.
So during that time period,
Right.
I suppose. But so I was kind of looking up the Trump 50-year mortgage. He had an interview with Laura Ingraham from Fox News just the other day, and she kind of questioned him about it.
Right.
So it's not like everybody's on board with the idea of the 50-year mortgage, but he got the concept, I think, from a guy named Bill. This is just a little background on it, just so people know what we're talking about.
Okay. Where the idea of the 50-year mortgage even came from.
Well, this Bill Pulte, if you guys have ever heard of Pulte homes, they're like new homes, that they, what do you call that? Like a neighborhood full of homes. They're the
Track
Pulte
homes?
I guess is that what you call them? Track homes? Yeah, maybe.
Yeah.
But that's what his family does. And he used to I think he was like the CEO, but he gave that up when he became the head of the Federal Housing Finance Agency, the FHA.
Just these neighborhoods where the houses are all sort of cookie cutter houses and kind of all the same.
Yeah, I mean,
They look
you know,
similar.
just, yeah, new houses. I feel like there were a lot of them out in Arizona, but maybe I have that memory wrong. I don't know. They've been around since the 50s. They're not new. You know,
Right.
they've been around.
Yeah.
But anyway, but he is now the head of the Federal Housing Finance Agency. And so apparently he started floating the idea of the 50-year mortgage. My pen's dying.
Uh-oh.
Oh, I got another one. So that's sort of where to Trump, you know, and then Trump picked this up. And the idea for them is right now housing, as a lot of us know, is really expensive and almost out of reach for a lot of especially young people trying to get into a first-time home. And by having the 50-year mortgage, your monthly payment would be lessened because it would be stretched out over so many more months.
Right. But just stepping back just one step, what is this problem that we have? That it's houses have become more expensive. They become less affordable. So how has that happened over the years?
Well,
There's a few.
depends on who you talk to.
Well, there is a supply and demand issue. So right now there is more people who want to buy a house than there are houses available. And there are several reasons for that. One reason is locked in mortgage rates. During the pandemic, people were able to lock in some really low interest rates on their mortgages. And, you know, they don't want to sell
Like
their...
2%.
Yeah, I don't know how low they got. But,
I think they got
but they don't want to sell their house because you'd have to refinance
at a higher rate.
at a higher rate.
Yeah.
So a lot of people are reluctant to sell. So that reduces the demand. Building costs have gone up. And because materials and stuff and building costs have gone up, builders don't typically want to build houses that don't have a good profit margin. So they have a higher profit margin with houses that are more expensive. So inexpensive houses, it's just not as much profit.
And
in
that's
there.
really kind of the supply and demand thing. I
Right.
don't know that it's totally that there aren't any houses. It's that they're too expensive for first-time home buyers.
Well,
there aren't enough affordable houses being built.
Right.
Yeah.
I also did read that in this country there's a gap between the supply and demand. It's like anywhere between 3 and 4 million homes. So there's we're almost 4 million homes short of the demand.
You know, I forgot to say something real quick.
Yeah.
Greg and I are not experts in anything. We are not economists or
No.
mortgage people.
No.
We've owned homes and we've
not
just sat
experts
around
at
talking
all,
about
no.
it. So take everything we say with a grain of salt. Okay, sorry.
You know, one more thing about why homes are more expensive is the local state and local zoning and land use laws and permits. They're just hard to get and they're complicated and it's a long process. You know, so in other
I didn't
words,
think of that.
like builders who want to build homes.
Right.
They can't just go in any city or any state and say we're going to build a bunch of affordable housing,
Right.
because there's all these zoning rules and regulations and permits they have to go through, and they're lengthy processes, and so that slows things down. That's why they're not building houses quickly. That's one reason.
Yeah. Well, what else? That was about
Why houses
why
houses have gone up in value so
Right.
much,
right.
you know?
Yeah. Well, is there anything to like the baby boomer generation is big? Is a lot of people, and a lot of them are living longer and they're staying in their homes and not selling. I mean, I don't know if that's the thing. I didn't look it up, but I can say on our street, on every side of our house here we
Yeah.
are. There's an old lady here who lives alone, an old lady here who lives alone, an old lady here, an old lady here. And they are
Yeah.
living in family homes,
Right.
you know. And then there's even like us who now our kids are gone and we live in a house, just the two of us. So you kind of wonder about all these people living a lot longer. Is that crazy? I don't know.
Right.
Can I just say one thing?
Yeah.
This might be borderline political.
Uh-oh.
Well, I just read a quote from Vice President Vance, and he said that it's illegal people living in the home, so if we get them out, then the homes will be available for other people.
What's illegal?
Illegal immigrants are living in the homes. So once ICE removes them, then the homes will be available.
I see.
But I would also question about the building costs, because a lot of people are builders. And so once their, status is revoked, because some of them do have like temporary status and stuff, then they don't have the builders. So there's two ways of looking
You're
at
talking
that.
about you're talking about the workforce.
Right, sure.
There's a shortage of workforce of builders.
Good grief.
building
The amount
houses,
of
and
masons
that's
who
part of it.
are anyway,
Right.
yeah. All right. So that's,
Another thing why homes have gone up, when you have a supply demand issue,
yeah.
when there's more people looking for houses than houses are available,
Yeah.
then the people who are selling the houses can raise the price.
Of course.
Because,
Of course.
and
Yeah.
there's a bidding war, and you've heard of stories where people have actually got offers that are above the asking price.
Right.
Because there's like so many people who want the same house. So that drives up the prices as well.
But I know, and this is again this, I didn't research this. This is my gut instinct. Okay, so just take it. But like in our area, there are areas where homes were much less expensive. And these, I don't know what you call them, like investment people, buy them all up and basically turn around and rent them for 10 times what they pay in a mortgage.
Turn them into rentals, right?
So there are tons. I mean, like in the area where our one son lives, he's rented from this same group because they own everything. So for like 4 different houses, he's rented from this group. And I know what they paid for them. I looked it up. And the amount they're charging rent, it's outrageous, outrageous, outrageous. And I think in like bigger cities that are touristy, a lot of the homes are bought up by people who rent them on like Airbnb and Vrbo and whatever. So that's part of what happens to some of the, people aren't staying in hotels, they stay in Airbnbs a lot of times. I don't know.
So
Maybe.
So we have a supply demand issue with homes.
Yeah.
Home prices are high.
Yeah.
And a lot of people can't afford to buy homes. So now the solution is what? The solution is to a 50-year mortgage is a solution because it does what? It lowers your monthly payment.
It lowers, right. And so then you might be able to, with less income, get into a home at all. Because some people, like, if you're making under, I don't know. Well, I can't even say because it depends on the city and everything. But you might not be approved for much. So if you have a 50-year, you might be able to get into a home that you couldn't otherwise get into. I think that is the thinking on it, right?
Well, people, they look at their monthly payments as like the big thing. How much of a house can I afford? And it all comes down to your monthly payments. Am I going to be spending $1,500 a month on my mortgage, or am I going to be spending $1,800 a month? And so by reducing that monthly cost by whatever,
right,
a couple $100 or more, that's the key. That's sort of the...
You know what it lowers it by, though? I thought this was interesting. I didn't double check this.
Right.
But I saw 8%. Which...
You mean the monthly payment?
Mm-hmm. And we'll talk about why that might not be really very much in a minute.
Well, the numbers I looked at on a typical mortgage, by going from 30 years to 50 years, you're going to save maybe $200 a month, at
Right.
most $300 a month, depending on the size of the mortgage. So yeah, you do save $200 or $300 a month on your monthly payments, your
Right.
mortgage payment. This is
Right.
just your mortgage and interest payment. You have other fees in there as well, your
Yeah.
property taxes and
Well,
insurance and things like that.
I do have some numbers we can look at in a minute. But first, let's just look at what are the pros of a 50-year mortgage.
The-
One pro, like we said, lower.
Lower monthly payments, but typically a couple $100, maybe $300, something in there.
Lower monthly payment. And it can help you if you're a first-time home buyer just to enter the market. Right?
Right.
So I think that is the main thing. It can also increase the amount of cash flow you have to like work on a home, I guess, if you were to get a fixer-upper. You'd have that extra, like you said, $200 a month or whatever to work on it. That's about all I could think of for pros. I don't know. I'm not sure what the other, but your cons of such a thing.
Oh my gosh, there's a lot. Well, let's first talk about this monthly payment savings. You know, typical mortgages are 15 years and 30 years. A typical 15-year mortgage has a lower interest rate than a 30-year mortgage.
I know. That's what I kept thinking about.
Banks,
So a 50-year is going to have an even higher interest.
banks are not going to give 50-year mortgages at the same interest rate as a 30-year mortgage. There'll probably be, it could be like 1% higher, plus or minus a bit. But let's just say it's 1% higher. So, or you can get a 6% 30-year mortgage, but if you want a 50-year mortgage, it's going to be 7%, which then means your monthly payments are higher. So now instead of saving $200 or $300 a month,
Right.
you're only going to save like $50 or $100 a month. So the savings is kind of small.
And the reason that they charge you more interest, I kind of did this backwards because it's showing like 15's up, but it really goes this way. Anyway, from what I understand, I get, a 15-year, the longer the mortgage goes, the more chance there is that you, the homeowner, may default on that loan because you lose your job or you have medical expenses or the whole economy takes a dive. There are different things that can, like during the financial crisis of 2008, so many people had gotten loans, mortgages that are now considered kind of junk, no doc loans and all these kind of things.
Right.
And so many people defaulted. There were houses in foreclosure all over the place. And so that's the fear, is that you'll never be able to pay it off.
So it's riskier.
So it is riskier for the bank to loan to you.
So they charge higher interest rates.
Exactly. So that's why they charge higher. Well, let's just pretend. All right, I got a note here. Hold on. Let me look at my note. Okay. So let's say we have a $300,000 loan on a house.
Now,
And
that's a good number,
we're
but
paying 6% interest.
right now in the U.S., the median home price is like around $430,000, which is the median home price. Median home price means that half the houses are less than $430,000, and half the houses are more than that. But which is a median number is better to use than a average number because multi-million-dollar homes skew the.
I'm just going with a whole number, so it's
Three.
easier to
I'm
look
just
at.
saying that 300,000 is a good number, but.
All right. So here's the deal, though.
I was just saying that the median home price in the U.S. is about $430,000.
All right, are you intentionally
No,
trying to mess with my train of thought?
I'm messing with your numbers.
All right, I'm trying to.
Okay.
So, okay. Hold on. Now you messed me up. Hold on, I gotta look at my note and think.
Oh no.
Well,
Numbers.
all right. So you're.
Man, I should have a little song and dance prepared for this silent.
All right. Well, basically, if you pay 6% interest on 300,000 for 30, no. Why 30? 20 years. What's the regular? Yeah, 20 years. Whoops. For 20 years.
No, we're talking about 30-year mortgage.
30.
Okay. so,
Excuse
so
me.
I,
My
I,
brain just
that's
got
okay.
messed up.
All right, I'm
okay.
sorry. $300,000 at 6%. These are nice numbers. A 30-year mortgage.
Okay, a 30-year.
You're gonna write down like how much interest you're gonna pay over the life of the loan. Is that what you're gonna write? The amount of interest?
Yes.
Okay.
But I was also going to do. All right. Yeah, let's do it over the life of the loan. Okay. So this is how much interest, not the total you'll pay, but the interest you'll pay, which is wild for even a 30-year, is 347,515.
So right,
so
buy
altogether for that house, you're going to pay 647.
almost
Isn't that crazy?
almost $650,000 for $300,000. But that is over 30 years.
That's over 30 years. And you could get a 15. I didn't do the math on that. But the 50-year, get this. This is how much interest you're going to pay.
I'm sure that number's going to double. Oh.
647,529. So over the life of the loan, you're going to pay almost $1 million for your $300,000 house. You pay over the 50 years and you don't make any,
You've just
payment.
doubled the amount of interest you're going to pay on that loan over the life of the loan. And you're only saving what? $100, $200 a month.
Hold on, I got another statistic.
See, that's the problem. It's psychologically, a lot of people think, what can I do to reduce my monthly payments?
Right.
Without, and then not looking at the long term, which...
Right. Let's look at this. Okay, so with this same loan at hold on. Okay, at 20 years, at the 20-year mark.
Okay.
All right, so we're looking at this loan at the 20-year mark.
After 20 years.
Now, if you had a 15-year mortgage, guess what?
You'd be paid off and...
You'd be paid off.
You have your house paid off. You own your own house.
If you have a 30-year mortgage, you will have paid $137,989 towards the principal.
Right.
But if you have a 50-year mortgage, after 20 years of paying every month, you will have paid $36,600 towards principal. So if you go to sell that house at the 20-year mark,
that's a crazy number.
This is all the principal you have. Now, hopefully the value of your house has gone up, but in some neighborhoods, it won't. You can't guarantee it'll go up. Probably it'll go up. But you know what I'm saying?
It's because the interest you pay on a loan is front loaded.
Right. That's right.
It's because
the first so many years you're not paying principal.
When they factor out how much interest you're paying each month, it's based off of the balance of the loan. So you have this $300,000 balance. Mm-hmm. You have a high interest. So when you make a payment, most of your payment is going toward interest, and only a small part of that payment is going toward your principal. So the principal gets slowly paid down. Right. And after 10, 15, 20 years,
if you're curious about this, I actually went into kind of a deep dive on it in a video that was called something like Mortgage Basics. You can look that up. No Frills ASMR Mortgage Basics. But I talk about even making, 2 payments a month and things like that. And that if you were to get like one of these longer loans, I would read the small print and see if they say anything about making early payments. Some places make you pay a fee to do early payments, things like that, because I would say there's an argument for getting this loan and then just knowing only if you know that you can make extra payments all the time. You know what I'm saying?
Yeah,
So that
yeah.
you could pay it off early, but not be required every month. So if you're doing like a fixer-upper kind of house, you could have some months where you don't pay it. You use that towards fixing up the house. But then other months where you pay off your mortgage
Well,
quicker. Maybe.
A couple things on that.
But you'd have to be pretty good.
First off, how many banks do not, or mortgage companies do not offer early payoff? In other words, they penalize you for paying off your
some of them
mortgage
do.
early.
And some of them let you make one payment regular and then one payment, I think this is right, towards just principal, but some don't.
That's just,
I could be wrong about
that's not good at all to get a mortgage where you're penalized if you want to make extra payments.
But a lot of them do that. At least they do it for a short time. They'll do it for like the first 5 or 10 years so that you can't flip houses as easily.
Right.
You know what I'm saying? So you can't take this loan and then just...
Well,
so and sometimes if you don't put as much down up front, like 20% down or whatever, then they'll have those kind of stipulations because they got to make their money.
Right.
I suppose.
Now you're talking about people making extra payments.
Yeah.
Okay.
But
here's the thing. The typical person who is like, oh, I need this 50-year mortgage because I got to save $200 or $100 or whatever it is per month because I can't afford.
Yeah.
That kind of person is not going to be able to make extra payments.
Maybe, but
very few people make extra payments.
Yeah.
Some people do, but most people don't. They just make the minimum. So,
but like you and I, we owned our own businesses, and so because of that, your taxes don't necessarily, like, because you write things off and everything, they don't reflect all your income. And so we always had trouble getting approved for any loan. But we could have made the payments. So I don't know. I'm just saying, if you are confident, you could do that.
Right.
But that's the only time I might advise that, I think. Wait, we're still going through the cons. So higher total interest is one definite con.
Well, I'm not sure where this fits in, but we're talking about how the beginning of a mortgage, you're paying off more interest than your principal. And then at some point during the mortgage, you end up, now you're paying more principal than you are interest. And just write these numbers down. For a 15-year mortgage, about year 8. Year 8 is when you've now are paying as much in principal as you are in interest. Before that, you're paying mostly interest. After year 8, you're now paying more principal in your interest. Okay, now for a 30-year mortgage, it's about year 12 is where it kind of balances out.
Okay, so that would be like here, sure.
But here's the thing, with a 50-year mortgage, this is going to be a crazy number.
Okay.
It's almost 40 years before you are paying.
That's wild.
So for 40 years.
This is a big difference, 12 to 40. Are you sure about that number?
Well, I'm not 100% sure.
No,
I'm
but
not
it's
100% sure about anything.
Well,
but
no, I know you're not, but it's because of this interest thing.
So think about that. For 40 years, you're going to be paying mostly interest.
Right. Yeah. Wow. All right. So higher total interest. So you have a slower accumulation of equity.
Okay, that's a big thing right there. You're building equity much slower. And one of the biggest reasons for home ownership is to build equity.
Right.
So if you never build equity, and also if something were to happen to the economy where home prices go down, right, you could wipe out that equity. If you have one of these long 50-year mortgages, after maybe 10 or 20 years, say 20 years of paying off your mortgage, and you've got a little bit of equity built up, not much, then the value of your house goes down.
Yeah.
Your equity is gone. Your equity is wiped out.
Yeah. My some of my family in Detroit back in the 90s, they had a lot of properties, and boy, their equity got wiped out, but now it's coming back. But yeah, it can happen. It can happen. All right. So the other thing we already discussed is you may end up paying higher interest. So when I gave you these numbers a minute ago with how much you would pay in interest, that was based on 6%. But if at a 30-year you're paying 6% and at a 50-year you're paying 7%, that's going to increase this a lot. I don't have the numbers.
You're going to be paying even more interest.
I'm not good enough about math, but
right.
Yeah. So having to pay higher interest is something you definitely want to look into if you're getting into one of these, see what the difference is. Because to be honest, once you have higher interest, if it's only bringing down your monthly payment by 8%, but your interest is higher, it might not really save you that much at all. And it's possible, I'm not sure about this. I'm not really sure. But on a longer loan, I think you might pay more. You have to get a more expensive homeowner's insurance policy because you own less equity in the house or something. I feel like that might be true.
More mortgage insurance?
Yeah.
Okay.
And the longer you have the mortgage, the longer you have to pay that mortgage insurance. Once you've paid off your house mortgage, then you can buy in just homeowner's insurance, not mortgage insurance. Does that sound right? I think that's right.
Yeah, I know a lot of mortgages require the mortgage insurance, but I don't remember how that works.
So
now I don't know if you mentioned this already, but the average age today of the first time home buyer has gone up.
Of course.
In 1991, it was 28 years old.
91? Is that when we bought our first house? No, we bought our first house probably in 94. When I was probably 24.
Well, today,
so there we go.
Yeah, today it's 38.
Oh, I don't know how you buy a house before that in most markets. Yeah.
So in the last 30 years, the average age of the first-time home buyer has gone up 10 years. They're 10 years old.
Wait, what did you say the age is? 38?
28 to 38.
Imagine, okay, let's say you're 34. If you buy into a house with a 50-year mortgage,
you will die.
You will be 84.
You will die with debt. You will die owning that house.
Wow, Craig, that's harsh.
No, you will, I'm sorry. You will die not owning your house.
Well,
and
at least you'll be
debt.
Into principal. If you don't die until you're 84.
So they talk about generational wealth.
Yeah, right.
This is generational debt.
Well, the only thing is the value of the home hopefully has gone up. So even if they have to pay off what's left of your mortgage, hopefully the value of the house is now more, or the property. Anyway.
Yes. I did read
hopefully.
that, houses are not going up in value quite as quickly as they used to.
Well, that's because they took such a big jump up, and I think now nobody can afford them. I don't know.
But you can't make long-term investments expecting, the value will go up. Usually it does, and hopefully it will, but it may not. Yeah. Of course, over 50 years, good grief, you would hope it would go up.
Well, so here's a question for you. Is getting into one of these 50-year loans, if that's the only thing you can get into, better than renting?
It's almost the same. I mean, instead of paying your monthly rent payment to a landlord, you're paying a monthly mortgage to a bank. And you build up equity so slowly. It's like you are forever a renter. You're just paying the bank instead of a landlord.
I would say there are a couple of things about it. I don't know. I just hate the way these landlords are jacking up their rents so high. It's outrageous. It irritates me. But if you're going into any mortgage at all, I don't care which mortgage you're going into, and I think I said this in the previous video, try to not go to the very tippy top of your what you can finance. Just because they'll give it to you doesn't mean that's where you should be. I mean, really look at what you can spend, because just because you spend, like, let's say you spend $2,000 in rent every month. If you get a mortgage for $2,000, you might be like, hey, I may as well get my mortgage at that rate because that's why I pay in rent. But in rent, that's really the top of what you're going to pay. But with a house, you're going to have taxes and insurance, which sometimes they include in there. You might have things you have to fix in your house. There's just expenses to owning a house. So just keep that in mind. Just a word to the wise.
But here's the thing. This whole idea of even coming up with this idea of a 50-year mortgage is to help with the affordability of housing.
That's right.
The problem is that a 50-year mortgage will make the problem worse.
Well, that's, what a lot of economists
because
think.
House prices will go up.
That's what they think. That because then people can afford more, the sellers will say, oh, I can bump my price up a little.
And also, you may have, let's say, a house that has a house goes on the market, and let's say there's 5 people who are interested in that house. All of a sudden now you've got 10 people who are qualified at that mortgage and can buy the house. Now you're competing with more people. So the asking price could be higher, and also the accepted price will be higher.
Yeah.
Because you got so much competition.
But the only thing
prices are going to go up.
I would say, maybe, and this is, I don't know, is if people can afford to get into a house and get out of the rental thing, then maybe these people who own all these rentals will sell theirs. And I think that's important for communities, because the more homeowners there are, the more care there is of the property. People who own their home are going to care for their property more than somebody who's renting a home, because you don't have any ownership over that. That's all I got to say about that. I don't know what that had to do with it, but I do think it makes a big difference. We really have to figure this out. You and I right now, we have to figure this out.
Oh, boy, we're going to...
How do we make this? Because I do feel a little... It's been a year now. I've been kind of looking with my son, our son, for a home that he can afford, along with, the student loan payments that him and the girlfriend have. So it's like complicated and expensive. And
but a 50-year mortgage is not the solution.
No,
it actually makes a problem worse.
But let's say,
it really almost in every way it makes it worse. One of the nice things about when you're younger or middle age or whatever, and you buy a home, is that someday you hope to have the house paid off.
Yeah,
you've paid off your house. You now own it. You don't have any more mortgage payments to make. With a 50-year mortgage, you're never going to have that house paid off. You're going to be retired. You're going to be 80, 90 years old and still making mortgage payments. And that's not the dream of home ownership.
We were talking about looking at the loan before you sign it to make sure you can
do early
payments. But the
extra payments or early payoff.
The other thing I saw that they said, because they're locking people in at this, I read this one thing that said they may try to make it that you can't refinance that loan, at least not for the certain amount of years, because otherwise they'd take a hit. Like, they're counting on you holding that loan for a long time. And if you couldn't refinance, if you locked in at like 6.5% right now, and it goes down to 2%, and you can't refinance, that blows.
Here's the thing.
You really got to look at the small print.
Here's the thing. A 50-year mortgage, who really benefits from that is the banks,
I would think.
The mortgage companies,
Absolutely.
Home builders who can now charge more money. They're the ones who are really going to benefit from this. Now, when a bank benefits by all these extra interest payments, then for a mortgage company to say, you cannot pay your mortgage off early, you cannot make early payments, you cannot refinance.
Yeah.
That, to me, that's just terrible. And
Yeah.
I don't know. I'm not getting into any kind of a deal like that.
No.
You're just trapped.
Yeah. Yeah.
It's a trap.
It's a trap.
Yes.
What is, Craig, you do the math. What's 8% of, just kidding. I know you can't do that.
Oh, 8% of what?
No, I was just thinking, like, I read the one place they said it would lower your monthly payment by 8%.
Right.
All right. So let's say your mortgage at a 30-year loan is going to be $2,000 a month. What would be 8%?
$160
I mean, that's
is
Okay.
8% of 2,000.
so it would lower it by $160 a month. Now, to get yourself into to paying almost $1 million instead of $647,000, and probably having a higher interest rate, that's not worth it.
It's not worth
That's
it.
not worth it.
You're only having a small monthly savings,
It's
but the
just-
whole benefit of buying a house and building equity, and then one day owning your own home, that part of the dream is like gone with a 50-year mortgage.
That's so sad.
Now, I remember I mentioned to you earlier today that Japan.
Yeah, you said that.
Did you look
I
that up?
did.
Japan had a similar situation, I think, back in the 80s or 90s, where
They started that when they were in a time of very low interest rates.
Okay.
Okay, so let's pretend like you could get a 50-year mortgage with only like a 2% interest. Then that might be a little more doable. But the problem was once they started doing them, they did 50, 70, and 100-year, what they called a
Like a multi-generational.
So you're
loan.
planning on having 3 generations live in the house and pay it. But that started when they had very low interest, and then interest rates went up. I think partially because of these things. And I think it did not work out very well for them, and they don't really do it anymore. But there are people locked into these 100-year mortgages. Wow, that is such a big assumption to make, that your kids and grandkids are going to want to live in the same house you live in. That'd be wild. But it's a different culture. I mean, I would love it if my kids lived here right now.
Yes.
It'd be fun. Anyway, yeah.
Yeah.
Well, one other thing. They can't do this 50-year mortgage just with a whim. There has to be legislation around it.
The chances of this actually happening is probably next to nothing.
Well, I don't know about.
Well, it's pretty low. But go ahead.
I don't know. Maybe. I don't know. Well, the last time there was sort of major legislation, I think, around mortgages was after the 2008 crisis. There was the Dodd-Frank legislation that came out in like 2010 that put it actually opened up a 40-year mortgage you could get, but it also put legislation around a lot of this stuff. But anyway, so to get a 50-year mortgage, you really can't right now. That is like insured by the federal, what is it, the FAA?
The U.S.
That's what it is.
Yeah. Yeah.
Oh, wait a minute, am I saying that? Whatever, the home, FHA loan. That's what it is. FHA, yeah. Federal Housing Administration. So, they like, what do they insure them?
Well, they're backed by. Did you know that?
Yeah.
Did you know that the 30-year mortgage is kind of unique to the United States?
Did not.
Yeah, I think most countries around the world do not have 30-year mortgages. I don't know what kind of mortgages they do, but I read that the reason why it's more common in the U.S. is because of the United States government backs these loans.
So the banks are willing to give them out.
Right,
Gotcha.
you got the backing of the U.S. government. That's what makes them possible.
Yeah. That makes sense. We had a 30-year
Yes.
mortgage, right?
Yes, we did.
How many years did it take us to pay it off?
How many years?
Yeah.
20.
That's pretty good. I talked about that on here. that we made extra payments.
Right.
But
I didn't do the math, but you do save a lot in interest payments, but I don't know what the savings was, but it was there.
well, all right.
So bottom line is,
You don't like the 50-year mark.
I think it's a terrible idea. It's a terrible, and I can't even believe that anybody with some basic knowledge and power would even suggest it as an idea.
I think it's just that there's so much
as a solution to a problem.
Of a need for first-time home buyers to be able to get into this market. That's where it all stems from.
But we've just showed the pros and cons of it and how it won't solve the problem. If anything, it
doesn't address the supply issue.
It'll make the problem worse.
It'll probably make prices go up over time. You'll probably pay higher interest. There's more risk to the lenders.
You'll have more demand, which will raise prices.
It is a little hard to see what the pros are other than just... I just think it has to do with the first-time home buyers. That's what the thinking is. So, but what if you're a house flipper? I mean, as long as you know you can sell that thing, you could just use it to get into a house, fix it all up, and flip it. As long as you know there's no penalty for selling early.
Well,
but I don't know how great that is for the market.
Right. I don't know how you're talking about people who flip houses. I don't know how would.
Well, I think
that's a different.
I think that was so popular before the housing crisis because people could get all kinds of crazy loans. I think they kind of made that a little because people were screwing up the market doing that. You know, it took out affordable homes because they were buying them and then selling them for much more money.
I mean, really,
on it.
What they really need to do is address the housing shortage.
Yeah.
They need to build more homes.
Yeah. So
there's not a huge gap between the supply and the demand. And it's not a quick fix. They said that no matter what, even if they tried to fix the gap, it'll take a number of years to close up that gap. But that's really what they need to address is the shortage of affordable housing. Not offering people mortgages where you save a couple $100 a month, but yet you're spending double the interest.
Are you building more like entry-level homes, or do you work harder at getting
interest rates down?
No, the old folks out of their homes, giving them some kind of special interest rate so that they leave their nice homes and go into old folk condos or something,
I don't
so
know.
that these family homes are opened up for younger families. I really think that's an issue. I look around a lot of neighborhoods, a lot of couples or single old people hogging up these family homes.
Well,
am I crazy? Is that wrong?
I don't know. You know
what if you give incentives to old people to move into smaller one-bedroom homes?
I don't know. A lot of older people are like,
you're talking about yourself, right?
Lived in this house, most of my life, raised my kids. I don't want to move out.
Or you encourage more multi-generational homes where you talk your sons into moving back home with the wife and babies. That's what I want. I don't know. Well, if anybody has the answer to all our problems, throw it in the comments.
Yeah.
Come up with the solutions. Anyway.
Okay.
I know there are more cons. I didn't write them all down. Well, I would say one thing is just the risk to both the lender and the buyer of over 50 years having something go wrong.
Higher risk.
It's just like
higher interest payments. It'll increase demand, which will increase probably prices.
The risk that something could happen and you won't be able to make those payments, and then you get foreclosed upon and you don't even have
any equity.
Yeah. That was very scary. Especially over that amount of time.
Yeah.
Although, what if you're like a 60-year-old person And you buy into one of these 50-year loans because I'm going to die anyway. I may as well pay lower payments. Or 50-year loans. You know what I'm saying?
Well, if you don't care about building up any equity, if you don't want to,
Especially if you don't have kids.
if you don't, well, I mean, if you don't have any kids, then you're like, whatever.
And then you take out one of those, what do they call those, backwards loans? Where you, the ones that like Tom Selleck.
A reverse mortgage.
Yeah.
Reverse mortgage.
I guess you have to have it paid off to get a reverse mortgage.
Yeah,
I think that's after you've paid it off.
After you pay it
get
off.
a reverse mortgage and they pay you.
Right, but then your equity in your house goes down.
You're going, into debt. But if you didn't have any kids, you could do that and just go on vacations.
Right, if you didn't have any kids.
Anyway, have anything else on the subject?
No, I think that's it.
Yeah.
I don't think it's going to happen, and I think it's just a bad idea.
Yeah.
There's so little upside to it, and way more downside.
Yeah, it seems that way.
I can't even believe it's an idea to begin with.
Well, I'm sure people said that about the 30-year mortgage when it came out.
No, actually, I think the 30-year mortgage at the time was really a great thing because of how things were happening before that. And 30 years is when people were, like you said before, people were buying homes younger.
Yeah.
You're in your mid-20s, 20s, 30s, 40s. By the time you're retired, you owned your own home.
Yeah.
And that's perfect.
Yeah.
By the time you're retired, your home's paid off.
Mm-hmm. Well, also back then, I think my parents, when they bought their first home in Detroit, it was like under $10,000.
Yeah.
For like a really nice, grand house. I know they made less too, but that's a substantial difference. Didn't your parents buy their house for like $3,000 or something?
I think it was $7,000 in 1960.
It's wild. I mean, yeah, I know incomes were different,
but the home prices in Detroit went way up,
yeah,
and then went way down.
Yeah.
Now they're back up again, but yeah, they did go up and down quite a bit.
But that is the thing. If you buy into one of these, and all of a sudden you want to sell it, and the home prices in your area have gone way down, and you're in debt by you've already spent that much. That's bad.
It's like you said, it's just like renting.
Well, you might owe money because you haven't paid any of the principal off, right? Yeah. Like, okay, let's say you bought the home for $300,000. You've only made interest payments so far. Now the home's only worth $150,000 because there was been a giant market drop. You try to sell, won't you owe the $150,000?
Well, first off, that's a 50% value drop.
It happened in Detroit. I'd say some of the houses did that.
What you're saying is the value of the home could go down for whatever reason. That's possible. Mm-hmm. Then when you decide or you need to sell your home, you may owe money.
Right?
You owe more than you.
I guess that would be true with any mortgage, but I never really thought about that.
In other words, to sell your house, instead of the bank giving you your equity,
they're going to say you owe us still.
To sell your house, you actually owe us $100,000.
That's why people get for it. That's when you just leave the house and let the bank foreclose it. That's why foreclosures happened in 2008. People just couldn't. The value went down too much.
Yeah.
And that is why those guys were shorting the market. That's what the Big Short's about it.
Right.
Anyway. All right. Well, we have to go watch some NFL football.
Okay.